of Delhi. And this webinar on understanding the impact of the pandemic on retirement benefits planning is very crucial. If I may just add, especially of people in my age group, but then even the younger people need to think about it. And we are delighted to have the entire team from FICCI. And with this, I will hand over to Ms. Soloja for her welcome remarks. So thank you very much.
Good afternoon. Good afternoon. Hi, can you hear me clearly?
Yes, so they can hear you.
Yeah, we can hear you.
Okay, so sorry, actually I had lost connection. So should I give my remarks now?
Formally, just once
Yes,
again,
please.
welcome you to please give your remarks. So that's what I said when you lost connection. So Ms. Kade, over to you.
Okay. So very good afternoon and good evening to all of you. And on behalf of FICCI, I take great pleasure in welcoming all of you to today's webinar. This webinar is on the National Pension System, which we are jointly organizing along with the PFRDA. And the theme of today's webinar is understanding the impact of the pandemic on retirement benefits planning. My special thanks to PFRDA for giving us an opportunity to organize this kind of a session to increase awareness of this very important topic on this virtual platform. I especially and warmly welcome Mr. Supratim Bandyopadhyay, Chairman PFRDA, and Mr. Das, Executive Director PFRDA, and thank them for giving their valuable time for today's interaction. Thank you very much, sir, for joining us. It's a pleasure that you have spared the time for this event. I think, as everybody knows, the National Pension System, which is a retirement planning investment avenue, has become more and more cost-effective and popular in the recent times. And we have just been informed that PFRDA has further simplified the onboarding for the subscribers due to this pandemic situation. So we are hoping that in today's workshop, we can learn some of these important and practical perspectives. This can further help everyone in these extraordinary times. Before we begin, I think, sir, we want to say that retirement benefit planning is a very important subject, which is possibly ignored and neglected in our country due to historical, social factors, where mostly parents were living with their children. Children were expected to take care of their parents, after their retirement. But today, I think there are some very big changes that are taking place in India as a country. Today, already 10% of the global citizens of the world are living in India. And with improvement in life expectancy, this is going to double in the next 15 years. So we are going to have more than 20% of global senior citizens living in our country. We should also note that only 1/3 of India's labor force and only 25% of India's senior citizens are accessing pensions. That means that we are actually grossly undercovered in this area. And further, I think with the increasing cost of living and escalating healthcare costs in our own country, plus factors like migration abroad and nuclear families, I think it's become even more important that people take pension planning seriously and remain Atmanirbhar after their retirement. So I think in this area, the work that you're doing is very much required in our society today. We have seen as employers that in the last few years, PFRDA has been very active in creating awareness about the NPS and its benefits and expanding its coverage in the country. Many initiatives have been actioned out and introduced, such as e-NPS, reducing the minimum contribution levels, introducing new investment instruments. I think with all these efforts, NPS has gained good momentum in recent times. And we hope that today's workshop can contribute to this to some extent. So we are very excited that you have spared your time to come and speak to all of us. And since we have such eminent panelists on today's workshop, I would like to request them to share their valuable insights on this important subject with all of us. And I'm confident that these presentations will be of immense value to all of us in our decision-making progress. With these words, I once again welcome all of you to this event, especially to our distinguished panelists. And we hope that all of you find this session interesting and useful. Thank you very much.
Thank you, Soloja. Thank you for sharing your opening remarks and why NPS is so important. Sir, I would request now Mr. Bandyopadhyay to give his keynote address.
Yeah. Thank you, Mr. Dilip Chena. Thank you, Mr. Mukhi. Thank you, Madam Firodia, and all other panelists. And I believe we'll be joined by Mr. Ritobroto Sarkar and Madam Beroz Kamdin also. So thank you for giving me the congratulation, because in fact I also forgot. It is just about 4.5 months back, but thereafter itself we went into lockdown and prolonged lockdown, and thereafter partial lockdown. So I simply forgot that I have taken over as chairman PFRDA. So thank you for reminding me. So so far as PFRDA and NPS is concerned, yes, definitely it is a challenging time. And I believe the kind of efforts FICCI also has taken to associate with us and engaging with us and the corporates to ensure that we could spread the awareness amongst corporates in a big way. So big thanks for that. And last year itself, we had 4 very successful sessions in Mumbai, Pune, Chennai, and Bangalore. And in fact, we wanted to continue in that fashion this year, but unfortunately, because of this particular time, we thought let us try to this digital mode, like our onboardings that we have started. So let us start in digital mode to create awareness for the customers. Yes, the corporate onboardings have been going on quite well. And I'm very happy to say currently almost 7,800 corporates are there with us. But the challenging part is that corporates are coming, but the take-up rate as to the number of employees who are joining, that take-up rate remains very, very low. It's between 2.5%, and maximum in some places may go up to 8 to 10%, not beyond that. Some corporates, of course, especially the central public sector enterprises, they are making it mandatory. And as a result of that, we are seeing that a lot of public sector enterprises, they have shifted existing superannuation fund, lock, stock, and barrel to NPS. And especially from the oil sector, we have seen BPCL, HPCL, Indian Oil, ONGC, Numaligarh Refinery, Oil India, almost everybody joining the NPS bandwagon. Apart from that, many other public sector units are joining. But where we really lack is the private sector corporates. There, though there has been some increase in the numbers and the increase in the number of corporates joining, so much so that this year itself, more than 200 corporates in the first quarter itself, they have joined NPS. But there, as I said, the challenge remains that after joining, what steps you have to take to ensure that more and more employees they join this. Yes, it remains a voluntary segment for many of the corporates. It still remains a voluntary segment. But despite that, as you said rightly, Madam Firodia, that now a large number of people will be above 60, and they need regular income to pass their retirement time. And the retirement period is becoming longer and longer with better medical facilities. Mortality rate is improving. And as a result, now on an average, we see people living for another 18 to 20 years after they reach the age of 60. But that period of 18 to 20, that is a very, very painful period unless one ensures that a reasonable amount of corpus is there to generate the kind of income that they require at that part of that life or that stage of their life. Because people say a lot of things that after I retire, I'll cut down on my this thing, expenses and all that. I believe those people, those who are having more gray hairs than black, they will agree with me. And those who have already crossed 60, they will agree with me that it really does not happen in life. That cutting down on your expense, cutting down on your lifestyle, it does not happen. Rather, expenses on certain accounts which we never planned for, like medical expenses, these go up exponentially. And there is no planning that can be really done about that. So, absolutely, it is a necessity. And in the amendment to the PFRD Act, and you must have seen in the last budget speech of our Honorable Finance Minister also, that she talked about auto enrollment. So we are thinking, especially in the MSME sector, can we really go for auto enrollment? So once the act is amended, we'll also think going for auto enrollment in the MSME sector in a big way. So far as numbers are concerned, so far the first quarter has been very good for NPS, both in corporate and individual voluntary segment. We have seen almost 33% growth in number. So during this lockdown period, you know that the periods have been very, very challenging. Despite that, numbers are increasing. Despite that, we have seen a steady growth in our AUM. So today, the total AUM under corporate sector is little over 47,000 crore. So there, the ticket size also is increasing. Each person is contributing more and more towards NPS. So these are all conscious decisions that people are taking when they are joining NPS, and they want to stay with us and to ensure that they create a reasonable corpus for them. Yes, to ensure that people can digitally onboard and they have less and less friction points, we have done many things like we have now offline Aadhaar XML through which one can be onboarded. The latest and big positive thing that has happened. Earlier, we got RBI permission for banks using Aadhaar eKYC for onboarding customers, like they are using for all other banking purposes. Only UPI consent was required. That also we have received yesterday. So after that, banks also for other banking purposes, the way they are using Aadhaar eKYC, they can use it for NPS onboarding also. And apart from that, we have done OTP-based onboarding and so many other. So far as corporates are concerned, we have given many other facilities. When the presentation is given, I believe Mr. Das will be giving the presentation after some time. There, all these things will be discussed. So far as income tax benefits are concerned, now almost it has become a triple E kind of a product, because the entire withdrawal available at the point of retirement, 60% is tax free. Yes, we are ensuring that the balance 40% go into annuitization, because that is required. Unless the annuity part is there and entire money is available to the subscriber, obviously we will not be fulfilling our duty in generating regular income at the age of 60. So that is the purpose for which we were created. We have allowed overseas citizens of India, OCIs, to join. We have allowed even Indian nationals of foreign embassies and foreign organizations to join. The first effort has been to onboard people from French embassy in Delhi. So a lot of things are going on, and positive things are going on, and more and more awareness is created. But I believe these kind of seminars and these kind of discussions are required to have a complete view on the NPS. And it's not from PFRD alone, from FICCI side also, the kind of help that you are providing. We are really thankful for that. And the kind of discussions we'll see from our actuarial friend, Mr. Sarkar, when he comes, and Madam Beros comes in. She's a senior partner of Deloitte, will throw a lot of light on the income tax provisions related to NPS. So that will give a overall picture about NPS, what it is, what kind of provisions are there, and how it can be utilized by a person. So far as NPS is concerned, try to keep it very flexible. so that it meets the need of anybody who is coming and joining. If you want to take a little bit more risk, we allow more equity participation. If you want to remain absolutely risk-free, you put your money in government securities. And for your information, government securities have been performing quite well last couple of months. One of our colleagues, he participated in 100% government security kind of a scheme for last 1 month. His return has been a phenomenal 11%. So these kind of things are there. And in between, from the regulatory side, we have allowed partial withdrawal even for COVID related treatment, because we thought it is a pandemic, and from the regulatory body also, we have to take care of our subscribers. If somebody needs, God forbid, nobody requires that, but if somebody needs, they can withdraw 25% of their own contribution, even for COVID related treatments. So with all that, and I thank everybody, because I believe we have to finish within a certain time limit. So with that, I end by again thanking Fiki and all the participants, because you are also sparing your time and joining us. And there are several other panelists, so there should be enough time for each one of them. So I hand over to Mr. Mukti.
Thank you, Mr. Bandyopadhyay. Thank you for setting the tone for the webinar and why NPS is important, and congratulations to you if you're seeing uptake already in this. We'll be happy to chip in as Fiki, as we have been doing for quite some years now. For 5 years, I've been doing NPS promotional programs. So I hope we'll be able to contribute from our end to this cause. Moving on to our next speaker, who's going to talk about impact of COVID-19 on retirement benefits in India. I would like to invite Rituberta Sarkar, who's the head retirement India for Willis Towers Watson. Rituberta, over to you.
Sure. Thanks, Deepak. Can you hear me?
Yes, we can hear you.
All right, so I'll just share my desktop. Just allow me a moment, please. Yeah, Deepak, can you see the screen?
Yes, we can see.
Is it visible?
Please go ahead.
Wonderful.
Yes.
Great. Thank you. Thank you very much. And thank you, Mr. Bandyopadhyay. At the outset, I would like to thank Fiki and the PFRDA for inviting me to the panel. So before I talk about the implications of COVID-19 on retirement benefits in India, I thought I will start by sharing some key insights on what actions companies are taking with respect to restoring stability to their business, and the impact that such decisions are likely to have on their employees. So Willis Towers Watson very recently fielded a survey across the entire Asia Pacific region, and it also had very good representation of companies from India. In fact, about 100 companies participated in the survey. And I wanted to begin by sharing some of the key highlights from this survey. So as you can see on this slide, a vast majority of companies, so in fact about 57% of companies that have been surveyed have said that they will have a moderate to large negative impact on their business. Obviously, no surprises here. Almost every industry has been negatively impacted. And in fact, only about 10% companies have said that they will not have any impact on their business. So I presume that these are primarily a couple of sectors which may be relatively less impacted, like e-commerce or pharma, just to name a couple. But by and large, across the board, every industry and every company has been moderately or largely impacted. So given the negative outlook, what actions are employers taking to protect their business, first of all, and also to protect their employees. So, in addition to restoring stability to their business, as you can see, companies are telling us that it is also equally important to take necessary action to support employees. So, for example, a third of companies have reported that the pandemic will have a large negative impact on their employees' well-being, which is very, very important in the few months to come. In terms of getting their business back on track, as you all know, several measures are being taken to control costs. And the most common measures are hiring freezes. So companies have completely stopped hiring and delays in salary increases. So normally, 1st of April is the most common merit increase cycle in India in the corporate sector, and most companies have either not provided any increase at all or have said that they will delay the increase cycle this year. And as you can see, that this applies to about half of the companies surveyed. So more than that, in fact. And in about 20 to 30% cases, employers have resorted to layoffs or have also reduced salaries of employees in extreme cases as well. So it is actually very important to set this context as part of this presentation, because such actions that employers are taking across various industries today can obviously have a material bearing on the overall retirement benefit package or the retirement planning that employees might be having over the last several years. So, what are some of the actions that employers are taking in connection with the support that they can provide to employees during these uncertain times? Now, it is quite obvious that the top priorities over the next 6 months are more around health and safety. Now that is understandable. So, most employers are saying that they will enhance their programs around employee safety. They will enhance mental health services and stress or resilience management of their employees. And most importantly, they are also saying that they will communicate more actively to their employees on benefits and on their well-being programs. So for today's discussion, I would focus primarily on the aspects relating to retirement or benefits, broadly, because that is the topic that we are focused on today. And the most important action that employers are taking with respect to retirement is around the communication of retirement plans and the importance of staying invested in the long term. So it is understandable that during such uncertain times, that employees would be extremely concerned about the erosion in fund values. And some may even make some impulsive moves, some may make fund switches, which may not necessarily lead to the desired overall outcome in the long run. So communication is really the key, and it has always been the key in our opinion. And Mr. Bandopadhyay did mention the take-up rate for NPS, and I believe that communication has always played an important part in motivating and promoting retirement benefits within the employee fraternity, and whether it is about decisions that they might be considering for retirement or relating to how equity market declines are impacting retirement plans and help them avoid any such knee-jerk reactions, or even more targeted communication to employees who are approaching retirement. So relating to the decisions that they may face in the current environment. So in fact, about 30% of companies have told us that they are likely to promote some form of independent financial advice for their employees who are close to retirement. So these are initiatives that companies are likely to take or are actively taking, to support employees during these uncertain, very stressful times. Companies have also realized that they need to use technology in the right manner to communicate about benefits. So So either the use of videos. I mean, nobody wants to listen to long town halls or presentations anymore. Quick messages through videos or e-cards are things that companies are looking to promote internally. And the other area that is seeing a major interest is financial well-being. Now this has already been quite. I mean, this had been picking up in India even before COVID-19, but because of the pandemic, I think this has picked up more actively, and companies have been promoting financial well-being in a much bigger way. And due to the anxiety and stress that employees are facing due to the pandemic and the impact financial worries can have on the overall well-being, companies are looking at initiatives to help employees better understand their finances and help them build a resilient financial position. So this is not necessarily restricted only to retirement planning, but this is being broadened, being looked at in a broad manner to cover all of financial planning at this juncture. The next aspect that companies have been talking about and actively looking at is around providing more flexibility to employees. So while staying invested in the long term is important, and we talked about that all along, companies also need to address the current financial situation of several impacted employees, especially for those companies that have had some sort of measure or some action with regard to pay or salary increases or salary reductions, so that employees who are impacted largely because of this do not suffer any sort of cash flow issues. So it is important that some form of flexibility with respect to retirement plans is also provided in the short term. And we all know that both the EPFO and the PFRDA have provided some flexibility, and I will cover that in the next slide. But there is probably more opportunity for employers to allow more flexibility with respect to voluntary contributions, especially for superannuation or for NPS for that matter. And finally, the other aspect that companies are obviously very concerned about right now is cash flow management. They're obviously extremely cost conscious. So this means that contributions to defined benefit plans, either defined benefit pension plans or gratuity plans, are contributions might get deferred or delayed. So companies might be using that cash for their business. And also we see that, again, from an actuarial standpoint, most employers may be reviewing their long-term assumptions, maybe not so much the long-term, but at least the short to medium-term assumptions being used for their actuarial valuations for defined benefit plans to take into account any short-term impact of the actions that they may have taken. So thankfully, when we did the survey, those companies that have defined contribution plans which are paid over and above the CTC, less than 5%. In fact, as low as 3% of companies have said that they will delay or reduce contributions. So it is good news that employers are not touching the retirement corpus, or probably it is not high on their radar when they're looking at cost control measures. And overall, what we see, the message that we are getting after talking to most companies in the corporate sector, that despite all the actions that have been taken, either salary cuts or employees are being asked to go on long leave, employers are telling us that they will try to retain the retirement benefits package so that employees are not impacted negatively in the long term. So even when they are cutting salaries, they may not necessarily touch the basic salary, for example, or they would want to ensure that at least the minimum contributions to the retirement benefits are protected. I would also like to talk a little bit about the various retirement benefits in India and just cover a few aspects with respect to the flexibility that I was talking about. So as you know, the EPFO has allowed employees and employers to both contribute at a reduced rate of 10% instead of 12% for a temporary period of 3 months. We don't know whether that's likely to get extended because of the ongoing partial lockdown. And they've also allowed withdrawals up to a certain threshold from the EPF balances. While many employees, especially those earning below a certain threshold, have welcomed this move because it provides more cash in hand. In general, we have seen in the corporate sector that most employees and corporates have tried or preferred to retain the contributions at 12% because they didn't want to touch the mandatory contributions at 12%. Similarly, NPS has also allowed withdrawals, and I believe COVID-19 is now added to the list of events under which withdrawals would be permitted. But again, it's perhaps better to stay invested for the long term, and something that corporates should be promoting and communicating to their employees to not use this opportunity to withdraw their NPS or their EPF balances at this juncture. For superannuation plans, we do not expect any major changes as most plans in India are through the traditional group insurance products, which have a capital guarantee and which is extremely important in such uncertain times. So we do expect that employers and employees will continue to continue to pay the ongoing contributions and not delay or defer or stop or for that matter reduce the contributions because of the impact of COVID-19. And similarly, for gratuity, obviously it's a defined benefit plan, so the benefits remain the way they are, and companies, as I said, might defer some funding this year, and this might lead to some drop in the funding levels, but overall the benefits are going to remain protected. As I said, basic salaries, if they are untouched, then employees close to retirement shouldn't necessarily be so worried. And leave also, long-term leave, leave encashment. We do expect the actuarial liabilities to increase this year as most employees are not availing leave. Nobody has gone on leave for the last 3 months. And we do expect companies to encourage or even mandate some form of leave over the next 6 months to control some of these long-term liabilities. And finally, before I close, I wanted to leave you with some quick analysis that we did of the back of the envelope, really, on the various NPS investment portfolios to demonstrate that in the long term, if you stay invested, then it may be possible to absorb market shocks as large as this. So this slide, for example, shows the investment returns achieved on the sample portfolios as have been set out on the slide with varying level of risk taken by different asset classes held. And the return on government securities and corporate bonds, which Mr. Bandyopadhyay was referring to, these reflect the mark-to-market increases because the yields have dropped quite significantly in 2020. So that has led to a mark-to-market increase on the bond portfolio. So if someone has someone has a balanced or moderate portfolio, then even the 1 year annualized return is pretty decent. Even under these circumstances, even after allowing for the market shocks that have happened, and it has ranged from 4.4% to 7.1%. And while the 1 year return for an aggressive portfolio is understandably low, and I don't think any mutual fund in India can also say that they have been able to generate any form of positive return in the short term. But the long term return, even after the market decline, is about 8%, which once again demonstrates the importance of riding out the volatility and not take short term impulsive decisions or chase short-term gains by continuously rebalancing your portfolio. So probably it's a relatively positive note to end my presentation. And once again, I would thank PFRDA and FICCI and hand it back to the other esteemed panelists. And happy to take questions either now or later during the question answer session. So thanks once again. Deepak, over to you.
Thank you, Rick. We'll take a question towards the end to save some time on the presentations. Thank you very much for sharing that very interesting, survey, and that's quite reassuring. There are a lot of companies who are even, cutting the salaries and not focusing on cutting the part which is, related to long-term benefits and retirement benefits. So thank you for giving us that overview. Now I'd like to invite Mr. A.G. Das, who's the Executive Director of PFRDA, to give his presentation on the NPS and the benefits for corporates in it. Mr. Das, over to you.
Yeah.
Sir, you're muted. Sir. Yeah. Now it is fine.
Is it audible now?
I think it's creating echo. The other computer is creating echo.
Am I audible now?
Yes, sir. You're audible. Please go ahead.
Okay. Thanks. Thank you, Mr. Mukhi, and good afternoon to everyone. I'll specifically talk about the national pension system, and just briefly, I will say that how it, it was how it came into existence. NPS, in fact, was notified on 22nd December 2003 for central government employees joining service on or after 1st January 2004, and replaced the existing defined benefit pension. Earlier, you are aware that there was a defined benefit pension for all central government employees. This DB pension scheme has been replaced by NPS, which is also called DC scheme, defined contribution scheme. NPS has been adopted by almost all the states for its employees, and it is also extended to all citizens of Indian on voluntary basis from May 2009. NPS also has been adopted by corporates for its employees, and it has also been extended to NRI and OCI, repatriable or non-repatriable basis. Now, coming to the present status of NPS, we have almost 350 lakhs subscriber. One second.
Chetan, please give the presentation sharing access to Mr. Milind.
Now, coming to the status of NPS as of now, we have got around 350 lakhs subscriber, and if I bifurcate this, you will find that almost 21 lakhs subscriber under central government scheme, central government employees, and under state government employees there are about 28 lakhs, and in corporate sector there are about 10 lakh subscriber. Under US we have got around 13 lakh subscriber, and there is a scheme called NPS Lite, which was known earlier was Swavlamban scheme. It was a Government of India scheme earlier. This scheme has been replaced by APY, that is Atal Pension Yojana, wherein we have got almost 214 lakh subscriber, and in NPS Lite we have got around 43 lakh subscriber. APY is a pension scheme by Government of India. It is being administered by PFRDA. The pension ranges from 1,000 to 5,000, depending on the requirement of the subscriber. Now, if I come to the asset under management, we have got almost 4,63,000 crores assets under our management in NPS and also in APY and NPS Lite, which again, if I bifurcate, state government under state government, it is almost 2,34,000 crores. Under central government, it is 1,52,000 crores. And in corporate sector, like Chairman Sir had told, we have almost 47,000 crores. And in NPS Lite, we have got almost 3,900 crores. In FPY, it is 11,343 crores. And under US, it is almost 15,000 crores. Now, coming to the number of corporates we have who have registered with us, it's almost 7,800. And if you ask me, the concentration of these corporates are mostly in almost 2,803 corporates are in Maharashtra, and it is mostly in western and southern belt of India, where the corporate concentration is more. In Maharashtra, it's almost 2,800 corporates. In Karnataka, it is 1,025 corporates. In Delhi, almost 864 corporates. And in Haryana and Tamil Nadu, almost 500 corporates each. And likewise. Now, if you ask me the features of NPS, basically, I would like to say a few things here. It is first of all regulated. It is regulated by PFRDA, which is established through an Act of Parliament, that is in 2013. It is a portable account. NPS account can be transferred across employment, location, and geography. It is a low-cost product. Probably, as per the OECD report, NPS is one of the lowest cost pension scheme in the world. It is very flexible. Subscribers have choices for the point of presence. Basically, these point of presence are our distributors who helps us in onboarding the subscribers. We have record keeping agencies which maintains the record. We have got pension fund allocation and asset allocation. The choices can be exercised and can be changed subsequently. Now, if you ask me the return, this returns in NPS is market linked and return based on the investment choice made by the subscriber. We have one slide later which shows the returns in each sector, each scheme. I'll cover that in that slide. And this is a very tax efficient product. Tax incentives are available to subscriber under Income Tax Act 1961. Just to give you briefly, I'm sure this tax angle also will be covered in detail by our next panelist. But just to give you, this tax benefit is available for both employee as well as the employer contribution under 80cc D1 for employee and up to 1.5 lakhs and another 50,000 additional under 80cc D1B. And for employer contribution, the tax benefits are available under 80cc D2. And employer also can claim this contribution to the employees under business expenses under 36(1) of the Income Tax Act. Now, the next is it is a very tax incentives. Sorry. It is a very transparent product. Subscriber can access their NPS account online 24/7, and all public disclosures are mandated. And lastly, This is a pension for all, can be voluntarily subscribed by any Indian citizen, resident, non-resident, and overseas citizen. Now, there are two types of accounts in NPS. One is that Tier 1 account and another is Tier 2 accounts. Tier 1 is a pension account and tax benefits are available in Tier 1 account. Restrictions, there are restrictions on the withdrawals in Tier 1 account, and the minimum contribution required is 500 rupees while opening the account, and minimum contribution per year is 1,000 rupees. And the subscriber can contribute any amount without any limit in Tier 1 account. So basically, this is an account where it is tax benefits are available, and along with Tier 1, the subscriber can open a Tier 2 account. This is an optional option given to the subscriber. Here again, there are no tax benefits, and there is no restriction in the withdrawals, and the minimum contribution to open again ₹1,000, and minimum contribution for per year is 250 rupees. Again, there is no contribution limits on the contributions. Basically, Tier 2 account is acts like a savings bank account normally in the bank. So, and the the choices are there for the subscriber to choose their investment pattern as per Tier 1 and or as per Tier 2. Now, how one joins NPS? If I talk about the entry, the subscriber between the age of 18 to 65 years can join NPS. They can join by physical mode. They can join by online mode. Again, in online mode, they can join through Aadhaar and or PAN-based KYC verification, because KYC verification is mandatory for opening an account in NPS. Now, we have got our intermediaries who works for us to in our structure. The first one is the record keeping agency. We have got two record keeping agency as of now. One is NSDL e-governance and other one is KFIN technology. We have got almost 7 pension funds, which are basically which invest the funds in the market as per the investment guidelines given by PFRDA under the parameters, and as per the as per the choices given by the subscriber, and basically these are the people who are responsible for investment of the accumulated funds. These pension fund managers can be changed by the subscriber once in a year, depending on the requirement of the subscriber. And if you ask me how these assets are being allocated, we have got two modes. One is active mode, other is auto mode. So under active choice, under the equity segment, one can have an exposure up to 75%. And under corporate, the choice can be exercised by the subscriber up to 100%. And under GSEC also it is 100%. And there is an option to exercise the investment choice in alternate asset up to a limit of 5%. And these choices can be changed as per the subscriber requirement twice in a year. Now, under the auto choice, this is basically a scheme wherein, depending on the age of the subscriber, the investments are made. This is basically for the segment of subscribers who do not want to take the own decisions of investment. There are three life cycle funds available presently for this auto choice. One is life cycle 75 and 50 and 25. Basically, this is the exposure. According to the exposure, these life cycles have been devised, and allocation constant. In case of LC 75, the exposure in equity is up to allowed up to 75, and in corporate bond up to 10%, and in GSEC it is 15%. When it comes to LC 50, the equity level comes down to 50, and bond level goes up, that is up to 30%, and in GSEC it also again goes up to 20%. In LC 25, basically for the people who do not want, who are little conservative in their investment pattern, the equity is limited to 25%, corporate bond it is 45% up to, and in GSEC up to 30%. Basically, these allocations happen in a very sequential manner. Up to the age 35 years, the allocation remain constant. Thereafter, the equity exposure reduces annually. In case of equity, if you ask me, the reduction takes place almost 4 basis points every year. And in, however, the corporate bond increases by 1%. I'm talking about the aggressive, that 75% of life cycle scheme. And in GSEC, it increases by 3%. So accordingly, the other asset class, other life cycles also, the investment, the exposure changes automatically. So the subscriber doesn't have to worry about, as per his or her age, the exposures gets changed. Now, coming to the accumulation and contribution, if you ask me, the contributions are done by the corporate or by the employee. When there is a contributions made by the corporate, it can be equal, it can be unequal. So there is again a flexibility available. And the funds comes to the pension fund managers, as I told earlier. And then as per the investment, unitization is done by CRA, that is Central Record Keeping Agency. And these units keep on growing, which forms the corpus of the subscriber contribution. Now, as I was saying, that return part. Now, if you ask me the average returns generated by the pension funds, we have by 7 pension funds since inception, as on 27 June 2020, equity has given almost 8.23% in 11 years. Corporate bond have given almost 10.49% in 11 years. Last 11 years, GSEC has given almost 10.28% in last 11 years. Under the central government scheme, where there are the exposures are fixed, it has given almost 9.88% in last 12 years. And under the state government scheme, it has given almost 9.78%. So if you see the returns given by the pension fund managers in NPS, is quite pretty attractive as compared to the other products available in the market or in the industry. So, and I think if you see the returns, that is compounded annual growth rate, this is one of the best product available for pension in the country as of now. Now, I'll come to the exit part, how a subscriber after joining, when he completes his term, reaches 60, how he exits from the system. So there are two types of exit happens. One is premature exit and one is normal exit happens at the age of 60. If a person wants to exit prematurely, there is a condition that 80% of the contribution will go into the annuity part. That is, it has to be given to annuity service providers for giving pension, and remaining 20% lump sums can be taken by cash by the subscriber. And in case of the corpus is less than 1 lakh, 100% lump sum he can take in cash. Under the normal circumstances, there is a provision that minimum 40% can be can be made for annuity, and the subscriber can take a cash component of 60%. However, if the subscriber wants to invest 100% in that annuity product, he can also do that. Like sir was saying that it has almost become a triple E product. If you ask me, the lump sum part of 60% is also now tax free, and 40% which goes towards annuity also it's tax free. So there is a level playing field between NPS and EPFO, which was not there earlier. And if the subscriber has a corpus of less than 2 lakh, he can take lump sum cash, 100% cash. And in case of death, 100% corpus is given to the nominee. Now, as I was talking about the annuity, we have almost 12 annuity service providers working for us, who gives pension to our subscribers. They are namely they are LIC, SBI, SDFC, then ICICI, and Max Life, Kotak, Canara HSBC, India First. And after the retirement, this annuity portion is given to this annuity service providers, and annuity service providers, as per the schemes of the annuity, provides pension to the subscribers. We have the annuity service providers have the different annuity schemes. Subscriber can choose any kind of scheme he wants for his requirement and join in the pension scheme. We have got almost 6 schemes presently available by the annuity service providers. That annuity payable for life at uniform rate to the annuitant only, annuity payable for 5, 10, 15 or 20 years certain, and thereafter as long as you are alive, annuity payable for life increasing at a simple rate of 3% per annum, annuity for life with provision of 50% of the annuity payable to the spouse during his or her lifetime on the death of the annuitant, annuity for life with a provision of 100% of the annuity payable to the spouse during his or her lifetime on the death of annuitant, and likewise we have got few more variants. Now, coming to the grievances part, we have got a very well managed grievances redressal system. We call it CGMA system. The subscriber, if any grievances he or she has, he has to report it to the concerned intermediary, to whom this grievances is pertaining to, and the grievances can be lodged by mail or by written application. If the concerned intermediary do not resolve the grievance, it is being escalated to NPS trust. We have a trust which looks after the day-to-day operation of the NPS, and again the grievances can be escalated by mail or written application, and NPS trust normally resolves the grievances. However, if the grievances still remains, it is being escalated to ombudsman. Ombudsman, we have appointed an ombudsman for PFRDA, who is in fact housed in our office only, He looks after the grievances and takes necessary decision to resolve that. And this can be the mode of grievances normally happens by written application. If it is still, if it still remains in the grievances still remains, it is being escalated to authority, that is PFRDA. PFRDA takes a decision, and if the subscriber is not satisfied with the decision of the authority, he can very well approach SAT, that is Security Appellate Tribunal. So the grievance redressal system is quite robust and quite transparent and quite simple to get the redressal done. So this is all I wanted to say, and thank you all of you for participating. And if there is any question, we'll take it in the last. Thank you.
Thank you, Mr. Das, for giving us that end-to-end overview of NPS from its features to exit strategy, everything. And it was very informative. I'm sure corporates who are not as of now enrolled would find it very useful. So moving on to the very important part, which makes our decision making or kind of on which our decision making is dependent, is the taxation and tax benefits. So I would like to invite Ms. Behrooj Kamdeen from Deloitte to give her perspective on how taxation, and especially in the recent times with due dates being extended, how that's going to be impacted. Over to you, Behrooj.
Thank you. Thank you, Deepak. Mr. Bhattapadia. Thank you, Vicky and PFRDA, for giving us this opportunity to discuss tax. Good evening to all participants. So we've been hearing the context setting done by Saloja. Very important to have retirement planning done in India, especially as we don't have full government support, and our life expectancy has been increasing over the years. So if you look at that and we consider that, retirement, and Indians basically are quite savvy of savings. So we've always been a saving rich country all along, and governments have also encouraged savings. So from that perspective, if we look at it, retirement planning is something which follows from savings that we've been doing. And therefore, it is an important criteria for us to save for retirement. And the context has been said by FICCI and PFRDA both. Now, a lot was discussed on the returns that are being given by NPS, returns that have been given by other funds and other products for investments. And one of the criteria that when we analyze return on investment, we generally look at tax, because the return on investment, whenever it has to be analyzed, should be net of tax returns. Because you do have certain products which are tax-free, certain products are taxable, and therefore whenever an analysis has been done for a retirement planning, it has taken into account the tax on this. So Milind, can you share the presentation? So basically what we're trying to cover in this presentation in the next 15 minutes will be to say what are the investment opportunities available for retirement planning in India, and what are the tax implications of those retirement benefits, and anything related to COVID related reliefs that the government has provided, how it has tax implications for it. So we go to the next slide. Next, we've already seen why retirement planning is important. So various investment opportunities. So whenever we discuss or we consider ourselves for retirement planning, we don't only look at the employer provided benefits like provident fund, superannuation fund, but we also look at other avenues which are there, like public provident fund, fixed deposit with banks, mutual funds, equity shares, life insurance companies. So what we've tried to do is we try to list out a few of the investment opportunities for retirement planning. And generally, we should have a proper mix of all of this. It should not be a case that we have everything put in one basket, because the risk is very high. And therefore, there should be a proper mix of all the investment opportunities that we have for retirement planning. And then we'll consider what the tax implications are for each of these. Next. So when we look at employer-related retirement plannings, there are three aspects that always come to mind. One is the employer contribution. Is the employer getting the benefit by contributing to an employee's account? So does the employer get a deduction as an expense for its business? Is the employer's contribution going to be taxable for the employee? That's another consideration that has to be looked at. What happens to the employee's contribution? Does he get a deduction for the contribution that he makes to the fund? What happens to the annual accretions? So the fund keeps accumulating, it's growing, the fund is growing, and you're getting annual accretions to the fund. Is that taxable during the life of the fund? And what happens on the withdrawal? When the employee reaches retirement age or has to withdraw from the fund, is the amount taxable? So earlier it has been said triple E generally when we look at triple E, it is exempt, which means to say that the contribution made by the employer is not taxable for the employee. The annual accretion to the fund is not taxable. And also when I withdraw from the fund, the retirement fund, it is not taxable. So that is generally what is looked at as EEE. And we will then see as to a few PF, superannuation and NPS, whether they strictly come within this EEE concept or not. So the next slide. So what we've tried to do here is we've tried to compare all of these stages in the fund process and see what the tax implications are. And every year the government keeps on amending the law through the finance bill. And what the government is trying to achieve, if you look at it from over the years, they are trying to say that reduce exemptions and you have a lower rate of tax. So if you look at the intent of the government is very noble. They're saying that instead of having complications, instead of having incentives for savings, and instead of really investing money, you have a lower rate of tax. And that is how the government has been working towards. So now when we look at the employer contribution for provident fund, if the employer contribution is excess of 12% of the salary, then it is taxable as per the 4th schedule of the Income Tax Act. However, they've also amended it now. The Finance Act 2020 amended the law to say that whatever the employer's contribution is, it will be taken in the aggregate of 7,50,000, and anything in excess will be disallowed, will be taxed. So the aggregate, we will discuss as aggregation and the budget provisions a little later, but to suffice here to say that employer's contribution to provident fund, if it's in excess of 12%, can get taxed because of the 4th schedule of the Income Tax Act. Generally, we've seen it's in the range of 12% or 10 to 12%. Therefore, generally, employer's contribution to PF is not taxable. However, the budget has made certain changes and we will discuss that changes a little later. Employer's contribution to superannuation fund. There is no threshold limit of 12 or 10% of salary. However, there was a limit of 1,50,000 till 31st March 2020. That limit has now changed, and what the government has now done is that they have said employers' contribution to provident fund, superannuation fund, and NPS, all in aggregate should not exceed 7,50,000. 7,50,000, then the excess is taxable. Sorry, you can go to next one itself. Yeah, just keep to this. No. Earlier. That's it. So basically what has happened is in this budget, they've tried to say that employers' contribution, which is in excess of 7,50,000, will be taxable. And for this purpose, to arrive at the 7,50,000, you have to aggregate employers' contribution to provident fund, employers' contribution to superannuation fund, and employers' contribution to pension fund. Now, when we look at the pension fund under NPS, employers' contribution to NPS was anyway taxable under section 17(1)(8). So it was anyway fully taxable. Still now it's going to be added in the limit of 7,50,000. So the question then arises is that which of this employer's contribution, so they have not listed the hierarchy. This has just come from 1st April 2020. They have not listed the hierarchy as to how this is going to be worked at. So which of the employer's contribution will be treated as being taxed is not being specified in the section 1727, and we hope that there will be clarity which will be issued. But if you look at the way the amendments have been done, it is basically done in the clause which was taxing superannuation fund, employer's contribution to superannuation fund. So the view should be that if there is any excess paid over 7,50,000, then that excess should first be attributed to employer's contribution to superannuation fund, then be attributed to employer's contribution to PF, and the last it should be attributed to employer's contribution to NPS, because NPS contribution is anyway fully taxable under section 17(1)(8) itself. It's already taken as salary. This is a so we need to wait for the government to provide clarity on this, but this is a view that could be taken. Now, when the employer's contribution is taxable for the employee, the government has also provided deduction under 80 2, which says that the employer's contribution to the extent of 10% of salary and 14% salary in case of central government employees will be allowed as a deduction under 80 2. So if a private employer were to contribute 10% of salary as employer's contribution, then that amount will be taxable for the employee, but he'll also get a deduction of the full amount under 80 2. So in effect, it is not taxable unless it exceeds the 7,50,000 aggregate limit. So in effect, in that manner, if you look at it, in the first triple E, which is there, exempt, employer's contribution, if it's less than 10% of salary or 14% salary in case of central government employees, could be exempt for the employee, provided it's below the overall limit of 7,50,000. As we know that from the current year, government has given an option to individuals that you may not take certain exemptions and you could come at a lower rate of tax under section 115 BAC. Employer's contribution is still allowed as a deduction, even if you go under lower rate of tax. So government has tried to do justice and give the benefit to say that employer's contribution will still be eligible for deduction under 80 2, even if you're going under lower rate of tax under section 115 BAC. We come to employees' contribution. Employees' contribution is anyway, my income is already taxed, so what I contribute can only be deductible for tax purposes. An employee contribution is deductible under section 80C in case of provident fund, but within the overall limit of 1,50,000. In case of superannuation fund, we generally don't have an employee contributing to a superannuation fund, and therefore this is not applicable. In case of NPS, again, there are certain thresholds, internal thresholds, plus an overall limit. So employee contribution up to 10% of salary is allowed as deduction under 80 1. And in case of other individuals other than employees, like self-employed persons, housewives, students, whoever has an account of NPS, gets 20% of the gross income as a deduction. And this comes under the overall limit of 1,50,000 along with 80C deductions. Additionally, this is the best part of NPS. You get an additional deduction of 50,000, whether you're an employee or as an SSC, as a self-employed person, you get additional deduction of 50,000. So this is the advantage of investing in NPS, because you're getting an additional deduction, clearly state you're getting a deduction. And this is where you're not applying the lower rate of tax, but this is where you're going on normal tax computations. You get an additional deduction of 50,000 by investing in NPS. And this is over and above the limit of 1,50,000, which is clubbed along with 80C. So this is clearly a benefit which has been given to employees and individuals for investing in NPS. The third benefit which has been given is that employees of central government are allowed to contribute to tier 2 accounts, and that can be considered for 80C deduction under the overall limit of 1,50,000. So tier 2 accounts, they have started giving the benefit. Tax benefit is being given. You have to keep their account for 3-year period. You cannot withdraw before 3 years. So you keep the account for 3 years. Tier 2 accounts also can be considered for 80C benefit. So this is a good initiative, but it's only restricted to central government employees. It is not given to other employees. It is not given to other individuals or self-employed or housewives or any other individuals who are non-benefit. So if you invest in tier 2 accounts, you have no tax benefits except for central government employees who get a benefit under ATC. If you've also considered in this, central government employees get a higher rate of deduction for employers' contribution of 14% of salary. And that's only restricted to central government and not to state governments, not to other employers. So that is very important criteria. You have to keep in mind that when you devise an NPS, employers contribution and employees contribution, you need to take care of these internal thresholds which are there as a percentage of salary, and also take care of the overall thresholds which are there as percentage of, as a quantum amount. So you have percentage of salary as an internal threshold, and you have a quantum amount as an external threshold. Both need to be taken into account whenever you're devising your NPS. Next, annual accretion. Annual accretion for Provident Fund till date, till 31st March 2020, was not taxable. It was completely exempt. Similarly, annual accretion for Employer Super Fund was exempt, and NPS also was not taxable. So all annual accretions were not taxable. The budget of 2020 has amended this, and they have now said that annual accretion by way of interest, dividend, or any other amount of similar nature, to the extent it relates to the contribution that is included in total income under section 17(2)(7)(a) of the Act, will become taxable. So annual accretions which are there, which is relating to the contribution over and above 7,50,000, would become taxable. The government is going to come out with a prescribed method. Since this is introduced now, this would be more applicable at the year end or in the beginning of the next financial year, because the limits will be looked at, and generally the interest or dividend gets credited only in the next year after the end of the financial year. So this will be more relevant from next year, and by that time we expect the government to come out with certain method of how this is to be calculated. And the wordings here is basically interest, any other amount. So the question also arises is, if I have a net asset value which has increased because of certain unrealized, I'm just doing an NAV calculation of my units which I hold under the NPS, would that come as annual accretion, or should that be kept out? And we hope that the government, when they come out with clarifications, also address all these issues. So hopefully they should address the issue of hierarchy, so that we are aware that this interest, dividend, etc. would relate to which contribution, whether it's to superannuation fund, whether it's to provident fund, or whether it's to NPS. So the hierarchy should be listed out, and also whether it will cover unrealized gains. So the NAV calculations which are being done, or would it only would be realized interest or dividends which the funds have received, would that be taken into account? So hopefully the method will be prescribed by government, and it should be done by the end of this year. Amount received on maturity, not taxable, subject to prescribed conditions like you've served for 5 years and all of those conditions which are there in the 4th schedule of the Income Tax Act. Otherwise, whatever you receive on maturity of Provident Fund is not taxable. Superannuation Fund, again, it is exempt from tax as per section 1030. You have certain conditions mentioned over there also. Pension Fund under NPS is also exempt from tax to the extent of 60%. It was earlier 40%. It has changed now, and it's become 60% of the cumulative total amount payable as per section 1012A. Balance amount for purchase of annuity is not taxable. So 40% which goes to purchase an annuity is not taxable. Partial withdrawals are not taxable as specified. So when we come, this is a slide specifically for NPS to say what are deductions we already covered in the earlier slide. This is just a summary only for the NPS part of it. And most important is to remember the internal percentage thresholds which are there. So deduction for contribution made to the fund in the previous year. So 80CCD1, which is up to 20% of gross income in case of non-individuals, non-employee individuals, and 10% of salary plus dearance allowance in case of employee taxpayers. And this is within the aggregate limit of 1,50,000, which is total for 80C, 80CCC, and 80CCD1. Additional 50,000, you get deductions. Clearly, NPS gets this benefit because if you're on the 33% tax slab, you get additional 50% deduction immediately. So you actually get a tax return on this. Contribution by employers, like I said, it's 10% of basic salary and dearness allowance, and 14% case of employer. And employer's contribution is fully taxable, and it's also taken into aggregation for 7,50,000. Contribute Tier 2 account by central government employees. Like I mentioned, it's only for central government employees, subject to you keeping it for 3-year period. It will be taken into account for deduction under ATC within the 1,50,000 limit. Withdrawal from the funds, amount received on closure, like we mentioned, it should not be taxable. 60% is exempt. Balance 40%, what you buy annuity is not taxable. It's deemed not to be received, and therefore it is not taxable. So basically here we come to the conclusion to say that it comes under EEE because it may come under the last E, the triple E, the third E on 60% what I can withdraw is exempt, and 40% what I buy annuity is not taxable. But when you receive the annuities, and we'll come to the discussion on annuity taxation a little later, but when you receive the annuities are fully taxable. Partial withdrawal from the fund, like it was mentioned earlier, 25% can be allowed as withdrawal from the employee, whatever amount is paid by the employee, and this amount is exempt. But the wordings here, if you look at 1012B, it speaks of employee. It doesn't speak of investor in the NPS. So non-employee investors like self-employed persons, housewives, students, or anyone else, professionals, may not get this exemption. So if anyone else withdraws from the NPS, it could be fully taxable. Next. Here we just try to have a table to compare other possible methods, and like what we've been seeing over the years, most of the times now the tax authorities have taxed the income. So you've seen dividend income taxation has changed from the current year, and dividends are taxable. Income from mutual funds are taxable. Interest in debt securities is taxable now. RBI taxable bonds is taxable. Fixed deposit companies, banks, public provident fund. Public provident fund is the only one where you have this EEE. My contribution, I get a deduction. Annual accretion is not taxable. Withdrawal is not taxable. Other than that, everything else is taxable. Tax-free bonds is not taxable. But if you look at it, most of the cases now, what we are seeing is that government is moving to tax the income that you earn on your investments. Of course, fixed deposit banks, you do get deduction under 80TTB for senior citizens up to 50,000 and 80TTA of 10,000. Next. Like I said, all this exemptions have been removed now for mutual funds, equity, debt. So there's not much. So when you invest in that and you earn income on that, it would be taxable. Next. COVID-19 reliefs are basically, we come to next. These are some of the reliefs that we have tried to capture in this, and was also spoken by Tao Watson. Mr. Sarkar has also spoken about it, that there is a reduction that can be done from 12% to 10% of monthly pay for the months of May, June, and July. And there was a notification which was issued by the Ministry of Labor and Employment. There was also a notification by EPFO. There was a letter of EPFO of 20th March 2020, which said that you can get a non-refundable advance to EPF members. And this is something which there were a lot of questions raised by our corporates to say that, is this taxable? Can you say it's a withdrawal? Can you say that there's a termination? Would this amount become taxable? And a view can be taken that this is only an advance which has been given, though it's non-refundable, and it should not. But however, there could be doubts on this. Like earlier it was mentioned, PA also has provided a clarification, and they've amended the rule in April of 2020 to say you can have partial withdrawals to fulfill financial needs towards treatment of medical expenses. However, they require medical certificate and formal request for partial withdrawal. Partial withdrawal, as we discussed earlier, is exempt only in case of employees. So if it's a non-employee who's doing a partial withdrawal from NPS account, even if it's towards medical expenses, it could be taxed. So that is something which maybe the government should look at it and provide exemptions to all individuals who are subscribing to NPS and not restricted only to employees. Investments for claiming deduction in the Chapter 6A. And this is very interesting. So because of the COVID being done in end of March, second week or third week of March, and everything coming under lockdown, government said that where you could not invest before 31st March 2020 for the financial year 2019-20 and you want to take deductions under Chapter 6A, 80C, 80CCD, you have time to invest up to 31st July 2020. So they've given us time to invest, whether it's Provident Fund, whether it's medical insurance, 80D, whether it's donations, which I do, 80G, or whether it's NPS contributions that I make in this current period, I can claim that as a deduction in the earlier year, subject to internal limits that we mentioned, subject to the overall thresholds also, which have been mentioned. But they have given time to make investments up to 31st July 2020. And this is also very interesting because if you want to opt for a lower rate of tax in the current year, you could still make these contributions till 31st July, claim it in the earlier financial year, 1920, and opt for the lower rate from the current year. So you get a benefit of actually paying subsequent to the year end, year ending March 31st, March 2020, get a deduction in the earlier year and go under lower rate in the current year. So that is feasible. The return of income filing timelines have been extended and it's now due for all individuals by 30th of November. The TDS returns will be filed for all the withholding taxes which have happened for the last quarter ended 31st March 2020. Those will be filed by July. So most probably the TDS certificates will be available by mid-August, and post that you can file your returns by 30th November 2020. But it is very important that when you're filing your returns, you take into account this extension of time for making investments. Next. That's it. So thank you, and we would be happy to take any questions on this and we can discuss. Over to Deepak.
Thank and thank you to all the panelists for finishing it in almost in time, all the presentations. So very big thank you for that. Now we would move into the Q&A sessions. We have received some questions in our chat box and Q&A box, and probably I would read out some of them, and relevant panelists and speakers can take up those questions. Maybe some of the panelists can maybe switch on their cameras as well. This is not in order of any preference. I'm just asking as it has been received. Mr. Rohit Jain is asking that presently change in fund manager and asset allocation can be done only twice a financial year. In our view, such restriction is detrimental to the interest of subscriber. Accordingly, same should be allowed. Some charges may be levied for same to the subscriber. Any take from PFRDA on this?
Yeah, I think I am audible.
Yes, sir.
So actually, as per the current regulations, fund manager can be changed only once a year. Asset allocation can be changed twice a year. Yes, if we get requests, we can definitely look into it. We can make it chargeable also. But my only suggestion here for any person who is making very quick changes, yes, we can do even once in a quarter also. There is no harm in that. But only thing is that pension being a very long-term kind of a investment, and in a volatile market condition, my only suggestion is that no subscriber should make frequent changes that may in fact affect the portfolio. And whenever you make a change, especially for the fund manager, my only request is that look into the long-term track record of the fund manager and don't look into the short term of say 3 months or 6 months or 8 months. Certain things can happen during these small periods, which may be not true for the entire period, because it is almost association for next 15, 20, 25 years. So kindly keep that in view. Yes, if we get requests, we can definitely look into it. That is not a big problem.
Okay. Thank you, sir. The second question is from Mr. N. Dileshwara. He's been asking, PFRD, as per PFRDA circular, balance in SAF can be transferred to NPS. However, fund managers, especially LIC, is charging 5% as exit load. Can something be done to waive this exit load?
Actually, we have received some such complaints, but when we look into it, actually LIC had all those things inbuilt in the as a part of their condition. When the particular corporate entered into an agreement with LIC for a group superannuation fund, they signed into that agreement and they said that if there is an early withdrawal within
Yeah.
certain period, there will be some charges, because when they are also releasing, suppose a big chunk of their total investment comes out of it just like that, 5,000, 8,000, 10,000 crore, they also suffer a loss, and at the same time existing customers also suffer. So to some extent they call it a wholesale surrender charge that they impose. So that is a policy condition. So kindly see that that minimum period is over, then only this charge can be waived. Otherwise, one other way of doing it is that maybe you don't surrender the entire thing at one go. So you can take it out in small bits and pieces. That way, maybe the charges can be not totally waived or avoided, but it can come down a little bit. That is my suggestion.
Okay. Uh, Mr. D.D. Goyal is asking one basic question on rationale or logic of treating annuity fully taxable in hands of individual, including principal amount. In our view, only interest portion should be taxable and not principal. I think that's
Should I take this?
Yeah.
Okay.
Yeah.
So, Mr. Goel, basically, in the under tax law today, there's no such clause which has been provided to say uh, there could be anything exempt for a policy which is being taken. So annuity is taxable, but there are, like it was mentioned earlier by Mr. Das, there are 6 types of annuity products which are there, and you also have an annuity product with a return on capital. So wherever you have a return of the policy premium itself, you're getting the return. Then what is being taxed is the annuity. So it depends on how you look at it. Having said that, yeah, we know internationally there are 2, 3 countries where they have actually given a deduction spread across 5 to 10 year period for the principal that is being invested, and this is something which the government will have to look at and give a benefit. But as it stands today, annuities, whatever you receive, would be taxable depending on the schemes that you're looking at.
Yeah, I entirely agree with what Madam Beroz has said. I only add to that fact that yes, return of capital is the scheme which is chosen by almost 90% of our customers when they exit. Because today the Indian psyche, human psyche, is that I enjoy during my lifetime, and thereafter whatever is left of the corpus is enjoyed by my family. That is the human psyche. And coming from an insurance background, I can tell you with confidence that almost 90% of the customers are choosing annuity with return of capital. So if you are taking the return of capital, that means the principal is going back, of course, to the your heirs, legal heirs. And what you are enjoying during the life is lifetime is the interest part. So that is taxed. And another bit of information is that already both IRDAI and PFRDA, they have requested that the annuity, at least the interest part, as Mr. Goel has rightly pointed out, it can be made tax free, because that is the only source of income for so many people who have retired. So don't make it taxable. That is for the government to consider, obviously.
okay. Yeah. Thank you, sir. Mr. Sanjeev Agrawal from Dwara Smart Gold is asking, is there any provision if a few employees are interested in enrolling in the NPS facility, but the company is not willing to enroll in the corporate NPS scheme because of limited interest or say awareness by the employees? So what should be done at that situation?
I believe now that almost all banks, I believe all banks are our registered distribution channels. We call them POPs, points of presence. Please go to your bank and they will onboard you to NPS. So, and many banks actually have taken it as a revenue model also. So they are taking a lot of interest, and they will onboard you. If you can make a group of it, and if you have common bank accounts, it is all the better. Otherwise, if somebody from the company connects us, we can try from PFRD side also to see that a particular POP visits your office and sees that the employees or group of employees who are onboarded. And that's good in the sense that what happens in NPS and any other financial decision, when a group of employees they join, maybe other employees also out of curiosity they come over and they also slowly start joining the scheme. That can be done.
I think there is a follow-up comment on it. So I'll just take one of his another comment which he has given in terms of that. I find that not just the employees, even the HR and finance department of many corporates are not even properly aware of the benefits of NPS accounts for their employees, and have a concern that the company is liable when an employee leaves the company. How this point can be addressed?
So yes, what Mr. Agarwal is telling is true, and that's why this kind of interactions we are arranging. But I believe we have Rito Broto in our panel, whether he wants to address this. Rito?
On the previous question also, because I think the question was specifically to corporates who are not willing to take the pain of going through the corporate NPS model, but a handful of employees want to enroll. So our general suggestion would be that corporate NPS, the enrollment is a relatively straightforward process, and most companies are also giving it as a voluntary sort of contribution. So it's not that the company is paying anything over and above the CTC. So it's a relatively easy process, and I'm pretty sure with corporate NPS also the online onboarding will be done in a fairly seamless manner. So I think Mr. Bandyopadhyay, some questions have come up that can this be done during the COVID environment? That can it be done completely paperless? The corporate onboarding. So if that is addressed, then I'm pretty sure corporates will be relatively open to onboarding employees for NPS.
Yes,
Okay.
definitely. We have taken a lot of steps to see that the corporate onboarding also becomes absolutely paperless. So that definitely can be done. That definitely can be done.
I think to your answer, I think he has written the bank is willing to onboard, but the company is not interested to offer it only for a few employees. But I think that's the private sector is not really obliged to sort of give that. What could be the solution in that case?
Yeah. So I think, yeah, I mean, it is a voluntary benefit. I don't think one can mandate any corporate to open the corporate NPS account. But the point I was trying to make is that it's a relatively straightforward process as compared to opening up a superannuation plan, for example, where you have to set up a trust, where you have to appoint trustees, where you have to have a governance of maintaining the trust. So corporate NPS, definitely, if somebody wants to offer retirement benefits over and above what is mandated under Provident Fund, I mean, corporate NPS is probably the only way to go. And therefore, obviously, the employees can't do anything if the employer doesn't want to offer it. But again, I think if the senior employees can convince the finance and HR that it is not a very difficult process. So I think eventually most employers will will open it up. I mean, today we see about 50-60% employers in the corporate sector have opened up corporate NPS, but we see over the next 2 or 3 years, pretty much everybody is going to give this as an option.
Thank you, Rito. I'll couple of operational questions. Seems, for example, I have two P ran generated accidentally. Now one is active and other is inactive. But the inactive account has 50,000 investment. How can I transfer the investment to the active account? Can anyone from PFRD answer this question?
Yeah. That is two plans generated accidentally. Now one is active, another is inactive. But the inactive account has 50K investment. How can I transfer the investment to the active account?
In fact, as per the
What can be done? The plan deactivation request is to be submitted to the POP, that is the point of presence through which it was opened, and through that only the corpus from the deactivated plan will be transferred to the active plan. That can be done. That can be done.
Okay. What is the procedure to be followed for change fund manager? I think it's a very basic questions people ask generally.
It's through online process you can do it, but I don't think in mobile app it is provided. It is provided. Mobile app also now they have provided. So either it can be through web login or mobile app. You can change the fund manager. But as I suggested earlier also, before changing the fund manager, don't take a knee-jerk kind of action, please. Look at the track record and look at the track record of the fund manager to whom you want to change. And then thereafter you take a decision.
Okay. Another gentleman is asking, APY account presently, can I also open NPS account as discussed for both tier 1 and tier 2?
Yes. Absolutely, you can open. So we allow APY account, one APY account to be present along with NPS also. You can have two brands and two accounts running simultaneously. These are allowed.
I think, sir, we have a couple of fund managers also with us, and I guess that question is from them that at 0.01% PFM charge, how can funds be managed prudently? What's the view of PFRDA, and is there any work going on to increase the PFM charge?
Yes. Work is going on, I can tell you. And the only reason why we could not float the new RFP for selection of fund manager and deciding a new fund management charge is that there are some issues on the FDI in pension sector. Now, I request the fund managers also, those who have raised the question, to have a look in the DFS site. On 19th of June, they have uploaded draft rule on FDI in pension sector, and they have invited public comments within 30 days. So if they have any comments to offer, they can directly offer it to DFS. And after 19th July, once all the comments are received, on the basis of those comments, they will finalize the draft. And after the draft is finalized and the rule is finalized, we'll issue the new RFP, and we'll ensure that, yes, we also feel and sincerely feel that 1 basis point is not the right fund management.
Okay, I have a couple of 2-3 more questions and then close it. So someone is asking, is withdrawal from tier 2 is taxable for non-central government members?
Yeah, now for central government employees, if they have tier 2, now actually today only we got the circular. We have been following up for quite some time. For central government employees only, they have given this benefit under section 80C. It's not that it is fully tax free. It's under section 80C, whatever tax benefits they are getting, to that extent they will get, and beyond that, whatever is there, that will be taxed. But we are trying to extend it to other corporate employees, other retail customers and all other NPS subscribers. So we are already following up with CBDT on this. So initially they have given it only for central government, because when central government had given that circular in January 2019, increasing the employer contribution to 14%, at that time in that circular, they had given a proposal that there will be a tier 2 account also for central government employees, which will be tax free, whatever is under section 80C to whatever limit it gives. So under that, now they have brought out the scheme, and now we are following up with CBDT to ensure that it is extended to other customers also.
Okay. So
Yes,
I'll take the last. Okay, okay. I'll take the last question maybe now. Superannuation to NPS transfer involve transfer of bulk corpus. Accordingly, different portfolios allocation should be allowed for the same in order to provide safeguard for each for such transfer.
Yeah, we have already allowed. We have already, whenever there is a bulk transfer, some bulk transfers have already taken place. It's not that it has not taken place. It has taken place, and we have allowed that. We have allowed that flexibility to ensure that this whatever. And fortunately, what has happened is that when superannuation funds are transferred to our NPS, more or less the asset allocation, we have seen that the pattern that we follow are more or less similar. There may be some small changes here and there. So that does not actually create a big challenge for us. And it is being done very, very smoothly. No issues on that.
Thank you. I think Barrows, I think there's one last question on the exemption side. Need explanation on exemption in ATCCD2. Is this benefit addition to ATCCD1B? I think you did explain that, but maybe can you just share something on that?
Sure. So 80CCD2 is basically for employer's contribution. So employer's contribution is a salary, and I get a deduction for that employer's contribution under 80CCD2. And 80CCD1B is the additional 50,000 which the individual can contribute over and above the 1,50,000 which is covered under 80CCD1. So that is the basic difference.
Yeah.
Employer's contribution comes under 2,
yeah.
and 1B is the additional 50,000 that I can invest in NPS.
Great. Thank you. I really don't see any further questions out here. Some of the questions which I didn't pick up were I think taken into the during. Yes, sir. You want to say something?
Yeah, just one point. I believe question somebody wanted all these presentation files to be shared. I believe so far as PFRDA presentation is concerned, absolutely we have no issue. We can share it with you. It is for public consumption, so that we can share with you, and if that can be shared to the.
Sir, I on the chat box I've just shared a link which is a YouTube link where this program was live so far, and people can revisit this YouTube link and see the entire discussion, video, presentation, everything. So it is there, and we will also send it in our email to all the attendees again who are not present here to watch this video on FICCI India YouTube channel. It is freely available.
Thank you.
Great. Great. So any other comments any speaker wants to, as a closing comment, wants to make? Otherwise, we'll close this. Okay. So thank you very much. I think on behalf of FICCI, again, big thank you to PFRDA and Mr. Bandyopadhyay. Thank you for having trust on us for organizing these, webinars regularly. And this is very interesting. And I think, as someone said, that awareness still, although I think the numbers you mentioned are decent numbers, but they can be, much more than what they are currently. And hence, these awareness program will certainly add a lot of value to that. And considering that today technology is helping us, so today, when we did program in Mumbai, Pune, we had people from Mumbai and Pune, but today we have people from across India, not just from Mumbai and Pune, despite it being done by a Maharashtra office. So this is the very handy tool, from the technology point of view, that your reach is quite high. And as I said that, if 200 people attend today, in a week's time on YouTube channel, 1,000 people view that same video. Hence the reach becomes, quite, high through these technology. So I think some of the benefit of COVID-19 is that we can surely very quickly, reach out to many people. And I'm sure that this whole presentation and discussion will be helpful to them who could not attend but would follow up on the YouTube later on. So thank you for collaborating with us, and thanks all the speakers for giving us wonderful presentation. The outcome of surveys done by Rito's team, fantastic, insight, from that point of view. And Mr. Das, thank you for sharing all the benefits corporate would get, out of NPS involvement. So thank you everyone, and thank you PFRDA team, FICCI team for arranging us. And a last and but not the least, big thank you to all the participants for staying with us for last 2 hours and listening to, patiently to our speakers and presentations. So we'll close this session here. And if you have any questions or any follow-up question, please feel free to write to FICCI. We'll be happy to take it to PFRDA. Thank you.
Thank you. Thank you.